Yes, so my name is David Butler. I am an audit partner at Bishop Fleming. I head up our charity team. What I'm going to talk to you about for the next 30 minutes or so is budgeting, financial planning. So what Ben was talking about was very much geared up towards the statutory accounts. So that's almost an external view. What I'm going to be talking about is some of the internal processes. And so, I'm assuming that within this group, there's a base level of knowledge, but you are not probably responsible for producing all the budgets and financial plans. So I'm really to talk to you a bit about some of the things around it and what those things should look like and what you can sensibly do with them. So as I said, this should take about 30 minutes. It may be a little bit less, in which case we've got about 15 minutes lined up at about 10:45. So that's what we'll aim for, but you never quite know these things. As Ben has always said, if you've got any questions, then please feel free to ask on either through the Q&A box or, it's a relatively sensible size group. So if you want to put a hand up, then or just unmute yourself, and then we can talk through those questions. That'll be absolutely fine. So really, what we're going to talk about in this section is one is that you budget in the first place. When do you budget? And what can you do with that information? So that's sort of a general overview. And then after that, I'm going to have another session which will be after the break, where we'll talk about monitoring financial performance. So really, that's what do you do once you've got your budget, what do you do with that information, and how do you provide effective financial oversight? I'll start with a bit of background, but the key thing is budgeting. Every organisation does it to one extent or another. They might not consider it budgeting, but pretty much every organisation will do it. But I think it's fair to say that given everything that's gone on for the last year or so, budgeting has never been trickier. One of the things, a budget is very much a forward-looking document. So the things Ben was talking about with the annual report and the trustees report and the statutory accounts, that's very much looking back. The budget and the financial plan is very much looking forwards. And clearly, if something's happened, pretty good certainty it's happened. If something is going to happen in the future, there's a lot less known, and so you have to make some assumptions and some predictions. And the world has become a very unpredictable place. So budgeting has become increasingly difficult. So just to give a bit of background before I dive into some of the detail, I'll really just give you a bit of background about why budgeting is important. And I can understand some people thinking it's a bit of a waste of time. In your home life, we all budget a bit, but to a certain extent, a lot of the budgeting is done by understanding what's in the bank. So why is it more relevant to an organisation? So hopefully, I'll just give a bit of background which highlights why it is a pretty important thing to do. So the slide you have in front of you here came from a couple of years ago, and it was a study that the Charities Commission did, trying to understand the public trust in charities. And what it shows, as you can see on this graph, is that public trust has been falling over recent years, and that is very much driven by the fact in the press there's been lots of scandals with your Oxfams and your kids companies and all those sorts of things. So the faith that people have in charities has been ebbing away somewhat. It was surprising when I first saw this. Given that it's out of 10, actually it's a relatively low score. But if you put that in context, charities still do pretty well compared to pretty much in every other sectors. Doctors are at the top and at 7.4, and unsurprisingly, the public body that people have less faith in, the least faith in, is MPs. And so you got like some Hancock. Those things do not improve the results for MPs. So although public trust is falling, it is still better than most of the public still have more faith than most of the sector. But it's something that people need to be aware of. When you look at the detail as to why they trust charities, I guess the really interesting thing is that, the slide is a little bit run the wrong way. But if you look right down at the bottom, you have transparency on expenditure, and that when they did the study, it was almost a surprising outcome. People had the most faith in charities when they had confidence on what they were spending their money on. You would have thought, it's right at the top, the fact that gives them the least confidence is whether it's run by volunteers. And it's easy to think with charities, ultimately, we want people who are really engaged in that charity's purposes to be running it, but actually, what the study found is, that's not the case. People want to see a charity that is well run, effectively run, sort of communicates that story, which goes back to the point Ben was saying about the impact in the annual report. So it's those things that are really important. And one of the metrics you often see people talk about is how much of every pound they spend on the charitable activity, and almost as though spending every penny you've got on charitable activities is the right thing to do. But actually, having sound financial systems in place and other sort of back office systems is really important. I mean, a charity needs to keep running for it to be effective. And there's no point in spending every penny you've got on the charitable activity if that means that in 6 months' time you run out of money. So actually having those really strong financial disciplines is a good point. And it's sort of one of my bugbears that there's so much focus on how much of the pound goes on charitable activities, because actually running a charity, to my mind, is the charitable activity. The charity needs to be there to carry out that activity. So that's one key point to take away. It is really important to ensure that your charity has those robust systems in place, and if it doesn't, I guess it's incumbent on all of us to be asking the questions as to why that isn't. And I'll talk about Kids Company a little bit, because that always comes up in these sorts of discussions. So this next slide just highlights some of the uncertainties that have made the budgeting environment that much trickier. So this was an article that was published right back at the start of the first lockdown, and it was saying charities could lose £4 billion in the 12 weeks. Because at that point, we thought we were going to be locked down for 3 months. And so this certainly from my experience and talking to my clients and the boards of trustees, seeing these sorts of headlines got an awful lot of charities into a real spit. Nobody knew what the future was going to be, and really it wasn't just charities. Everybody was rapidly trying to change what their plans were going to be. But charities in particular, this headline said it's going to cost them £4 billion, and so that's a massive chunk of the charity sector disappearing. How do you plug that gap? So if you have a budget of some description, I suspect the lockdown would have rendered that budget fairly irrelevant. But it's what it did, certainly in my mind, as lots of trustees' minds, is focused on thinking, we need to plan for the future, and ultimately that is really what a budget is. It is your embodiment of what the future is. You think the future is going to look like. You will never get it right. Things will always change. But essentially, the reason why we budget is because you are trying to create a plan for the future, and by having that budget, it enables you to assess how accurate your prediction of the future is and how close to that plan you are. And if you're not close to the plan, you have an option or an ability to do something about it. So as I said at the start, the things I'm going to go through today are, one is we budget, how do you budget, and when do you budget, and those are sort of the key factors. So we've probably already covered some of the items on why it is you need to budget, and I'll go through these in a slightly random order. So after this slide, I'll talk about some of the legal reasons why you need to have a budget, which I guess are the slightly more drier slides, because ultimately, even if you don't want to budget, most charities need to have something in place. It's not just good practice. There is a legal obligation to do so. So I'll touch on that, but then also talk about the real sort of pragmatic reason for having a budget, and that is the first bullet point on here. There is a real value to having a plan. The second bullet point is that legal responsibility point, which I'll touch on next. But then the other things are it is how do you plan your resources? If you need to recruit lots of staff, or you need a bigger building, how do you know you need a bigger building? I mean, if there is a strategy in place to grow the charity, that dictates the size and shape of the charity needs to change, because you've got different your charity projects may be expanding, or the level of service is expanding. Having that budget, it's intrinsically tied into your plan. certainly what it has highlighted over the last few years is the value of a budget in identifying problems and pinch points. Lots of charities I work with, as I say, they had a budget before the pandemic, which almost got get thrown in the bin, but became irrelevant quite quickly. But then, a revised budget was put in place very soon because as it became clear what the future was going to look like, you need to plan for that new future and understanding where the likely problems are going to come. That enables you to plan around them. And then the last one on here is about cash flow, and I'll talk about cash flow because the budget is one thing. So a budget is very much looking at what you expect your income and expenditure to be over a period of time. From an accountant's perspective, the really significant thing is what happens to your cash flow, because you've got income of, as in Ben's example was sort of £300,000 coming in. It's the key thing is when you're going to receive that £300,000. It's one thing to say in my accounts I recognise £300,000, but if that doesn't come in until the end of the year, then how am I going to cover those £300,000 worth of expenditure in that year? So cash flow and budgeting go hand in hand. And for many charities, and certainly over the last 12 months, cash flow has been a more important thing than the budget. But as I said, they are very, very closely linked. So I said I'll talk about the sort of the legal commitments first for charities. So there are two things in here. One is to do with a concept called going concern, and then the other are the legal responsibilities on directors and trustees. And I'll talk about both. So the first thing is a going concern. So what that means is, and this applies to any organisation. So when you produce your financial statements, it says in there the trustees consider that the charity believe the charity is a going concern. And what that means is it can pay all its liabilities as they fall due for at least the next 12 months. So ultimately, if a bill comes in, you've got the money to be able to pay it. It's a relatively simple concept, but in uncertain environments, it can be hard to prove. So what it is now incumbent on all trustees to do is every year they need to think about, one, it is how can they positively assert that they are a going concern, and this is more relevant for the larger charities, but every charity should be doing the same thing. So the trustees should think, how can we get ourselves comfortable that we are going to be able to keep going, keep providing the services we do for at least the next 12 months, but really you should be looking a bit more into the future than that. And ultimately the way they do that is by having a budget and a cash flow forecast. And so it's one thing for a trustee to say, yes, of course we're going to be around. We've been going for 50 years. We're not going to be going for 51 years. But there needs to be something to underpin that. And that's your budget and your forecast. So there's a new auditing standards. So for charities that need a statutory audit, there is now a requirement that the trustees have a formal statement to say why they're a going concern, and as auditors, we then need to audit that statement and say in the financial statements that we agree that the going concern basis is appropriate. And so, as an auditor, that's quite a tricky thing for me to agree. So, previously, I don't know how many of you as charities are audited, but I would like to think none of you have ever read an audit opinion, because it is one of the driest or legally phrased documents you can imagine. But it's full of caveats, and certainly with going concern, we would never positively state that we thought, that we agreed this business would be here in 12 months, this charity would be here in 12 months, because all sorts of things happen. We now, as auditors, have to say, yes, it will definitely be here. And so to do that, we need to make sure that we also believe your budgets and your forecasts. So the requirement has become, it's become a much higher hurdle for us as auditors, but it also means it's incumbent on senior management teams and trustees to also get themselves comfortable with going concern. So actually, we'll just draw it. So then with regards to actually, yeah, go back a slide. So with regards to the legal duties, so as trustees have a duty to manage charity resources responsibly. That's all one of the things set out, and so ensuring that it is a going concern is a key part of that. And again, you go back to your budget and your forecast and your cash flows. But directors also have a legal responsibility to ensure that they are not trading whilst insolvent. And again, that's a very similar concept to going concern, but it means, I mean, if you're insolvent, technically you would have negative free reserves, and you're not able to meet your liabilities as they fall due. And one of the things we'll come on to later is that point on free reserves, which Ben mentioned, and I guess there's a question on, because the distinction between free reserves and unrestricted funds can be pretty critical. So I'll touch on that a bit, but yeah, the legal requirement for directors and in a charity, directors and trustees are interchangeable terms. So if you're a trustee of an incorporated charity, you are a director, so you have both responsibilities fall your way. And if you're not a trustee yourself, then clearly your trustees would be looking to you to make sure that they're able to fulfill their responsibilities. So Kids Company, whenever the charity seminar of any description, Kids Company comes up for fairly obvious reasons. And I guess if you ever wanted an example of where there wasn't a laser-like focus on budgeting, then Kids Company is it. So I mean, they've been sort of battered by the press over the last probably 4 years now, and some of it is justified, but not all of it by any means. However, from a financial management perspective, what they had was a very risky financial model. Ultimately, they needed to keep raising funds continually because they're expanding their services all the time, and so they were successful at raising those funds for quite a long period of time. But actually, from a budgeting perspective, what it should have been flagging up is that actually this is a really risky business model, because we have got we need to raise an extra £5 million this year to enable us to fulfil our duties, and that's what they weren't doing. So yeah, Kids Company is the lesson to the sector. You can be an ambitious charity, there's nothing wrong with that, and you can be trying to expand rapidly, but there is a duty of care for charities to act prudently. So they shouldn't be taking the same risks a company would, and having a budget helps you to understand those risks. So this next slide, essentially I borrowed it from the NCVA website, which I don't know if any of you have looked on there, but there's some useful information on all sorts of financial management. And what they say on this, they have this slide appears in one of their packs, and so it says your budget is the embodiment of your strategic plan, and this is where the sort of the Kids Company thing failed out. And so you have an open loop here. Ultimately, your budget should be a translation of your plan into financial terms, and you can't really have one without the other. So what this says is, what is it you're planning to do? And ultimately, some charities may be happy doing exactly what they're doing. So they think next year is going to be very much the same as this year. And in those circumstances, the budget is a much more straightforward exercise. Ultimately, you're taking what we've done last year, and I think actually it's going to be much the same this year. We need the same number of staff, we need the same building, and all those sorts of things. So that's quite an easy exercise. If there are going to be any changes, then the first question is, what is it we're planning to do? So you might think actually, we're a charity that provides care to a nursery, for example, and we do 2 to 5 years old, but actually we want to do we'll take them from 6 months. That might be the purpose. I think actually, so that's what we're planning to do. But how do we go about doing that? I think we need more space, we need more teachers. So the next question is, what resources do we need to do that? And it will be, we need more staff, we need a bit more space, we need some more assets, and then you consider how much are those going to cost. Plucking a figure out of the air, say it's £50,000. So you already, you've got a plan of where you want to go, and you're already looking at how much that's going to cost you. And then you think, well, where's that money going to come from? And in this case, you might think, well, there'll be some government funding, there'll be, we can charge the parents, that we could do some sort of fundraising. And then to the next point is, can we afford to deliver that plan? So, and that's the real key question. Can you afford to deliver that plan? And I think in this case, I conclude we want to do this, but we just don't think we're going to get enough income to do it. So something else needs to change. And the reason why this is sort of an open loop is that if the questions that last, if the answer to that last question is can we afford to deliver it, if the answer is no, then ultimately you have to go back to the start again and think, well, actually that plan doesn't work. So either we change our plan, or we reconsider where we're going to get the money from. So that really is your strategic plan, but it is so closely tied into what your financial plan is going to be, because you can't really do one without the other. It's all well and good to have a sort of blue sky thinking session, but ultimately, your finance team at some point will have to get down to the nuts and bolts and make sure that the finances are achievable, because like I said, charities have a duty of care to act prudently, and if they're not, then one, you're not complying with the duties, but two, you're going to get an awful lot of financial difficulty very quickly. But to enable you to answer all those questions, then you need to have the budgeting process consists of a number of different elements. So the first thing you need to think about is when is it you're going to budget, the level of detail you're going to produce, and then you get some really key things to do with assumptions. And so budgeting can be done in any level of detail. I've seen all sorts of different budgets of different sized charities. Some are unbelievably detailed, which take forever to produce, and arguably it doesn't matter if you're planning for next year and your budget is £1 million. Doesn't matter if you're going to spend £500 on new chairs. So you have to just ask yourself, what is the right level of detail? You need it to be. You don't need to get down to the nuts and bolts, but it needs to be detailed enough that if there is an expense where the costs are going to turn out either significantly higher or lower, and that variance will have an impact on your ability to carry it out, then that sort of dictates the level of detail you need to go into. Going back to one bullet point to the timing, I've seen some people produce their budget sort of 6 months through the year, and you think, well, it's good to have a budget, but there's no point in doing it if it's that late. You got to start. You need to be producing your budget before you enter the financial year, where possible. Honestly, I appreciate in some cases that simply isn't possible, and there's lots that's unknown. But if you've got a plan for your next year, that's when your budget needs to be produced. It shouldn't be. You think about the strategy, and then months later you're thinking about how that fits in financially. You want to enter the year with a plan. If you're going on a holiday, you would plan how you're going to get to the airport, how you're going to get from the airport to where you're staying. Having that plan is crucial, and that plan needs to be in place at the right time. So that sort of covers the first 2 bullet points. So then the assumptions used is a pretty critical bit, and this is where probably the time-consuming bit of budgeting. So there's certain things. If take for example, an independent school. I just use that as an example simply because they've got lots of costs and lots of income. But if there are certain assumptions they need to make. So if, for example, they're thinking, right, well, next year we expect to have a similar number of pupils. We're not expecting to need any more space. So you think, well, actually, our building costs have been whatever they have been this year. We don't think we need any more. People numbers are going to be pretty similar. So therefore, next year we can assume property costs are going to be pretty similar. And so those are sort of the easy things to make. You then get to the situation where you think, well, actually, we know we're going to probably lose 5 staff in the year, because that's what always happens. So you then need to think, well, we're going to lose 5 staff, so we need to recruit another 5, and there's going to be a recruitment cost in line with that. So, and then that factors into your budget. So all those bits just start to build up the costs. There'll be, you'll know that teacher salaries are going to go up by a certain percentage, teacher pension costs will go up by a certain percentage, and so you factor in inflation of some of those costs, but you don't really think actually, we are, we might have some special needs we need to cover this year, and so there's going to be additional costs for that. So those bits where you then need to start thinking about, what are the likely costs of those, and ultimately there's always going to be an element of guess about it. Nobody knows, if you're in an independent school, you don't know until September how many children are actually going to turn up. I mean, kids could be going to other schools, it could be all sorts of things going on. So there's always going to be an element of guess in there, and your budget will never be right. So you can make all the best assumptions in the world, and you will still get it wrong. That is pretty much an inevitability. But you want to be, you want your errors to be as small as they possibly can be, and so really thinking about the assumptions you're making is the right way to do that. And ultimately, if you start with last year, and make some sensible assumptions, and then factor in what your plan is going to be, that's where you get the numbers from. You have a bullet point here on scenario planning, risks based, and these have been sort of critical points for the last 12 months because there has been so much uncertainty. So if, again, take an example of an independent school. When the first lockdown started, lots of independent schools take their children from overseas. They really had no idea what the impact was going to be on overseas borders, whether the borders could get into the country, whether they would want to come to the UK. So they would have they would have 2 or 3 budgets. And so you think, we have what we expect to happen. So we expect them to be able to come back, expect them to be able to pay their fees, might have to give them a discount, but they're going to come over. But then they also have a second budget, which would be actually going to lose 50% of them because they just won't want to come to the UK anymore. And so what that enables them to do is, because they had a couple of plans, once the facts became known, they could easily decide which plan they were going to follow. And that's happened for most independent schools. Things weren't as bad as they thought it was going to be. So it enabled them to revert to plan A. But having that plan B gave them confidence that actually, if this does happen, we've got a plan in place, which means we can get through the year and we can survive into the following year. And it's so having not just a plan, but if there are significant risks that you're facing, having an alternative scenario it is really important. And so the last point on there, I talked about reforecasting. So that is very much tied into it. So if things fundamentally change, then your budget should be changed to reflect that. Yeah. So it's great to have a plan, but if your budget is miles away from what reality is, then it's not helping you at all. So having a reforecast and a new budget is sensible practice in those circumstances. So then again, just talk about cash flow management, which I'd already mentioned, and a point on the bottom, all as accountants, we all say sort of cash is king, and I can't really overemphasize how important it is for there to be a cash flow forecast that accompanies your budget. I have some charity clients that, the exceptions where they've got, they might have a £20 million investment portfolio, they've got £3 million in the bank, and their cost for the year might be £2 million, so they don't give out money. And you think, well, in that case, cash flow forecast really isn't that important at all, because they're sat on absolute bucket loads of money, and it's something that goes so terribly wrong. But it's so unlikely. So in those few cases, cash flow is not that important. But given the year we've had, understanding when your money comes in and when you've got to spend it, it is an absolute fundamental. Because what it will do, if your cash flow forecast is prepared correctly, then it will enable you to identify periods of time where your bank balance is as low as it's going to get. And so again, using the independent school example, they've got a very established cash flow cycle. So typically they receive their fees at the start of a term, and then they spend them, and then you get to the start of the next term and the money comes in. So for most independent schools, their cash flow is at the lowest in December before the next term's fees go out. And so they understand that, and so they have to plan their cash flow to make sure that either they've got enough money in the bank or they've got a big enough overdraft facilities to enable them to keep paying the wages and any other costs in that period of time. So yeah, if you can understand your cash flow cycle, that really will help you understand where those pinch points are, and it will help you understand when you've got a substantial amount of time. If you needed, for example, you realised you didn't have enough sort of financial headroom, then you've got time to go talk to the bank and work out whether you can have an overdraft, or you need to take out a loan, or you need to sell something, or save some costs. But yeah, understanding when those pinch points are is absolutely a real fundamental. So the two go hand in hand. In terms of how you go about doing it, and the easiest ways, I mean, the last bullet point on here is, if all else fails, Excel. If someone's good on an Excel spreadsheet, they can use that to put a budget together, and use that to do a cash flow statement. But at the same point, there are loads of free resources you can get online. The Charities Finance Group has got some templates on their website. There's a free resource. There are some bespoke packages you can buy. And there's plenty of off-the-shelf tools as well, which some of them are very expensive, others much less so. But I say the vast majority of my clients probably end up using either Excel. Let's say the majority use Excel, and then others have budgeting tools that are that integrate with their accounting systems. So there's lots of stuff out there that you can use. But the key point is that you have a budget and a cash flow forecast in the first place. And then, because in the next session, what we'll talk about is what it is you do with that information you receive, because it's all really good having lots of information, but it's then the critical point is what you do with it, and how you provide effective financial oversight.